Hello and welcome to another edition of the E-commerce Odyssey podcast. I'm here with Juan from Boopos. Juan, could you tell us a bit about yourself and your company, please?
Sure, Trevor. Pleasure to be here today with you. I started the company 1.5 years ago, more or less, by the end of 2020, when all the people were kind of buying Amazon businesses like crazy. So I learned that there was an opportunity there. But I'm more of a finance guy, so I wanted to focus in helping these people buy companies, given that they needed to raise significant amounts of money, and not so much in the operation. So the idea from the first minute was to help them acquire the companies by lending anywhere between 50 and 80% of the purchase price. So that's what we do. We lend money for acquisitions.
So what's the kind of commercial deal you come into? You know, obviously you don't have to share details, just broadly speaking. What kind of rates do you charge? How long do people have to pay it off?
Let me get you through an example. I think it's going to be easier. So let's say that you're going to buy a company that is worth $1 million US, and this company is making 1 million in revenue and 200K in profit. So then we will probably lend somewhere between 700 and 800K, which is between 70 and 80% of the purchase price. Nice. And somewhere in between 3 and 4 times profit. So that's the kind of metrics we look for deciding the amount that we're going to lend. So if you like the amount and you're ready to use your cash for funding the rest on your own equity, then you will buy the company with our funds. And then what happens next, we take security over the assets that are being acquired, but we don't take any type of personal guarantees from the buyer. So that's kind of relevant. Okay. And then it gets repaid throughout the course of around 5 years. It's a flexible variable schedule based on revenues. So we take a cut of revenues and go into the example again. That will be probably around 15% of revenues, which is a portion of the profit. And we get repaid with that until we get to a multiplier of the amount we lend, which is usually 1.6 times throughout the course of 5 years. Okay. So in the example, it would be getting back 1.1 million, maybe. And there's also something important. If you are able to find cheaper financing after 1, 2 years, 3 years, we don't want to get in the way. So we will have a discounted multiplier. So if by the end of year 1, you're able to find financing, instead of charging 1.6, we would charge 1.15 times the principal amount that we lend in the beginning.
Okay. So, I mean, do you think that, because obviously there's been a lot of M&A activity around FBA sellers recently, I mean, presumably you have to you must value the acquisition target. I mean, would you basically, if someone wanted to borrow, pay more for what it was worth, what would you do under those circumstances?
So we don't really care so much about the amount being paid. We have a limit on the amount that we can lend. So if you're able to fund the excess of that with your own equity, or even add a seller note or an earn-out to bridge the gap to seller expectations, then that's fine for us. What we have to make sure is that we don't lend higher than 4 times SDE or the profit of the business. Okay,
so you're valuing the acquisition target on a kind of 4 times multiple? Is that right?
More or less, yeah. That's the amount that we can leverage the company. But if you want to pay 8 times and you want to pay those other 4 times out of your own equity, then that's fine for us.
Right. So you can do that. Okay. So have you seen? I mean, because obviously, have you seen the prices that people are paying go up? Because there's obviously a lot of demand. Have you seen the prices go up?
That's a good question. First of all, we're focusing on the smaller segment. So we are lending tickets between 100K and 1.5 million. So that kind of sets the type of market we're heading to. And for that market, we're seeing that the multiples are steady between 2.5 times and 4 times SDE, maybe 5 times for very good businesses.
SDE to set the profit, basically.
Yeah, exactly.
What does SDE stand for?
Seller discretionary earnings.
Okay.
So it's kind of like profit before the salary of the owner himself.
Right. Okay.
And I guess that in that segment in particular, there's not so much of an inflation in multiples. I think the segment above, like deals between, I don't know, 2 to 10 million, there's a lot more competition, and that's where the multiple inflation is happening right now.
Okay, so there's a lot of funding companies out there. What makes you guys different?
So I guess that our specialization in acquisition financing is the key. I mean, we have a lot of peers and competitors that are lending on Amazon businesses, on SaaS businesses, on e-commerce businesses like we do, but they're usually funding growth. So that means that they're lending small amounts, maybe 1 to 2 months of revenue. They expect to get repaid throughout the course of 1 year. And they don't really understand the kind of nuances of financing the acquisition of a business. So that's our main differentiator. We're able to lend bigger amounts that are useful for acquiring a business. And all of our structures are geared towards helping people buy businesses. So we are kind of an analysis partner. Before they buy a business, they will have our pre-approval so they can see whether the business is good or bad, and then they rely on us for understanding the downsides. That's the type of things that we do. And other platforms, not so much. They focus on growth and other type of deals.
Okay, so what kind of what do you look for? So do you look for anything? What are the criteria that you look for from the company that's borrowing the money for you? Have you got any particular things that you? So
the type of businesses that we lend on, as I said, Amazon, e-commerce and subscription-based businesses. And in terms of Amazon businesses, we look at the product portfolio itself. So we have to make sure that the products are very, very well positioned within the Amazon marketplace. They've been around for a while. They have good reviews. They have, in general, we have like a scoring model that analyzes the positioning of the products that the business is selling. We compare it to competitors. That we do a kind of detailed analysis of the product portfolio. And other than that, we look at financial ratios. So it's relevant for us that the tacos, the advertising cost as a percentage of sales is contained, that the company is profitable overall, and we like companies that are making at least 10% of profit compared to revenues. And if it's 20 or higher, then much better. And obviously we look for, declining assets are doable, but they get penalized a lot in our model. The way we look at the businesses, we look at the past 24 months. So we look at monthly P&L for the last 24 months. So when that is not available, because the business has not been trading for more than 12, 18 months, that penalizes a lot. It will still be doable, but in the end, it gets much harder to go through our underwriting process. And I guess those are the main kind of restrictions that we operate with. We're pretty flexible. There are also some categories that we don't do. So we don't do jewelry or supplements. We don't do basic electronics. But other than that, we're kind of very open in what we can do. Okay.
So what should a company, if a business was looking to buy something, what would you recommend as an acquisition target? How should they go and find one?
That's a good question. I mean, our analysis focuses a lot in the health of the business and the downsides. So we make sure that there's not so much risk when buying a business. We don't look so much into the upsides, which we kind of leave that part of the analysis to the buyer. So from our perspective, we're looking for a category that is super solid, that is profitable, where competition is not so high. And profitability and growth is not super important for us, but it would definitely be a plus. But what we look for is products that have a very, very good, positioning within the marketplace. In the end, what we're looking for is for businesses that are going to be still generating revenues in 5 years, which is our average term. So that's what we look for. Other than that, in terms of upsides, etc., I would recommend to look for opportunities to improve in terms of having some room for increasing the marketing budget, which is usually, so if you find businesses that have 20% tacos, that means there will be not so much room in terms of increasing the marketing budget and growing it more. This type of things, this type of opportunities that are good in terms of making the business grow, because organically the Amazon marketplace is growing more or less steadily at rates of 10%. But if you want to have a high growth opportunity, then you have to find these little upsides and improvements that you can do.
Okay, so I mean, do you find that people have a particular size of product portfolio, or is it just
So we underwrite per target. So in the end, we've learned to repeat clients and people who are aggregators and build a portfolio of products. But we've also helped people buy a small niche product or small company, and we're happy with that. We don't care so much about that. If obviously the ability to have diversification in terms of product portfolio is something that is good, because if one of them fails, then you have more on the agenda. But I think it doesn't make sense to spread yourself too thin, because if you have a lot of products that don't sell too much, then it's usually very hard to manage. So
okay. I mean, do you think this whole kind of, buying up FBA businesses, I mean, it just seems like a bit of a bubble at the moment. Do you think it's going to burst, or what do you think of the future holds for the market?
So in the end, I mean, people buying businesses have been around for many, many years. 500 million businesses or small businesses are sold every year in the US, and around 300K in Europe and the UK. So it's huge, and there's always a lot of people. There will always be people wanting to be their own bosses, being entrepreneurs, etc. What we're seeing now is that all these people that are looking to acquire a business have found that the Amazon marketplace offers an opportunity that is kind of easy to action and understandable for everybody, and that's why everybody's flocking into this kind of hype. We're seeing people kind of shifting towards D2C sites and Shopify sites now, and more people interested in other types of businesses like content sites, etc. So I guess that the overall trend of wanting to buy a business will always exist. Whether they're going to be Amazon businesses or other type of businesses, well, we'll see over time. But at this stage, I would say that Amazon still offers a very good opportunity for people to become a business owner. Okay,
great. Excellent. So last question, what has inspired you recently? This could be e-commerce, finance, anything.
And that's a question I like to, because rewinding back to how I started this company, I initially tried to look for ways to acquire companies. And the reason why is because I like to work with business owners, entrepreneurs, and people who are managing small businesses, talking to them and understanding them. And that's something that I get to do now, and it's super interesting. I mean, each of them has a different story. Each of them has a different strategy. And if you gather all those pieces, then there's a lot of inspiration that you can gather from these people who are kind of heroes, if you look at them. I mean, they are so focused in creating something, in building something. That's the type of inspiration that I get from them, and it's super cool.
Excellent. Great. Okay, well, lovely to speak to you, and good luck for the future.
All right. Great, Trevor. Thank you.
Thanks. Bye-bye.
Bye.